This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So you were in Australia, as anyone who listens to every single episode of the podcast would know, or I guess if they at least listened to the one where we talked about the fact that you were going. But one of the things that you got to do while you were there, which I think it's really cool, you got to interview Dave Butler, who is the current CEO of Dimensional Fund Advisors. And like Dimensional or not, like us talking about it or not, they're a massive asset manager with an unbelievable history connected to the academic world of finance. So, like him or not, the interview was fascinating.
Yeah, he was a real treat to spend time with and has been there, since they're a very small company, has been part of their growth story going back to 1995. So he's been there, seen the growth, and has spent a lot of time with the academics and knows these people and the stories behind it. And the history behind this company is unreal.
But it wasn't even just that. Like, he had insights on investing, he had insights on Dimensional, but he runs a company that has 1,500 employees.
Yeah. Insights
globally.
on leadership were amazing.
That's exactly it.
And he's an interesting guy. He was very straightforward. We got, I think, a good zone of conversation, and the hour flew by. So I think it's a really fascinating listen from a leader of a great asset management company. Yeah,
I would say it's definitely worth the listen for his insights from all different perspectives.
So it is a bit longer than usual. I think it's well worth the time.
And it's for our little old podcast, it's a pretty good guest.
Oh, it's a big guest. It's a big deal. Now, he's a genuine guy, super nice, had all the time. Not all the time because he had a meeting to get to, but he was in no rush. Said, take the whole hour, I'm fine. Ask me anything you want. And
it was a really good conversation.
All right, have a listen. So this week we have a very special guest joining us, and I'm super thrilled to be able to spend some time with you. Dave, welcome to the Rational Reminder.
Thank you, Cameron. Appreciate it.
So my first question, as you know, we use dimensional funds with all of our clients. I'm curious, how would you describe dimensional funds?
I would describe Dimensional as a firm that's really in the pursuit of delivering a really great client experience. So when I joined the firm 25 years ago, that was really what stuck out to me, was this persistent pursuit of truth, of trying to find the right answer in the capital market space, and then obviously delivering a client experience that not only meet expectations, but exceeded expectations as well.
And you have a very impressive athletic career, and your story of how you ended up here I find fascinating. So you were actually drafted by the Celtics, right, back in 87?
I was drafted by the Celtics in 1987. They actually had a strike the year I came out. So normally basketball players would go to the rookie camp and have a chance to try out and see how they perform versus the veterans. And that year they didn't have a rookie camp.
And you would have had a shot at the NBA? Pretty good shot?
I would have had a shot at the NBA, yeah. So I was sitting there basically at home on my mom's couch waiting for this chance to go to the camp, and I got a call from my agent the night before saying that the strike was on, and there's a good chance the strike was not going to end for the whole year.
Amazing.
So I was kind of dumbfounded as to where I wanted to go, what I wanted to do. The next night he called up and he said there was a team in Istanbul, Turkey, that had seen me play in college and wanted me to come and try out. So I was a 22-year-old kid and had never been to Turkey, and they were going to give me a round trip airfare and a hotel and work out for 4 days. And I thought, I'm going to be at home working out for 4 days anyway. Why not go and see Istanbul? So I went over there, and I was in the best shape of my life because I was prepared for the Celtic camp, and had a great tryout. And they offered me a contract that was basically double the size of what I would have made as a rookie in the NBA. And so I had one of those dilemmas in front of me that said, well, do you wait for your dream and go to the NBA, or do you just take this contract in Turkey? And it really wasn't that I was going for the money. It wasn't that at all. It was more of the fact that I felt that the positioning on the strike was it wasn't going to end, and I would be sitting there the whole year not working on my game and getting my skills better and better. So my thought was, I'll go to Turkey, I'll play a year, I'll have to be the top scorer. I'll have to learn to score at a more consistent pace. And then I'll come back to Boston the following year even better and come back and make the NBA.
But it didn't quite go that way.
Didn't quite go that way. So but probably about 3/4 of the way into the season, I was at a practice and we were doing a drill, an up and back drill, and where you sprint to one line, you backpedal the next line. And when I was backpedaling and I took off to the next line in front of me, I felt this snap in the back of my Achilles and calf. And sure enough, I had basically torn what they call a gastroc, which is the muscle between the calf and the Achilles. And so that knocked me out for, a handful of weeks. And
did you kind of know then your career wasn't going to have that path you were expecting?
No, when you're 22 and you're big and strong and fast and you think you're invincible at the time. So I thought to myself, this will take me a few days to get over. And unfortunately in Turkey, there's only one, what they called import, one American per team. So I was the only American, and I was the main scorer and rebounder and all that stuff. Right. So they sort of rushed me back into onto the court probably before I should have. And the doctors after the fact tell me that the muscle didn't basically kind of just reacted to that and formed a lot of scar tissue in my calf and Achilles. So I came back, I finished out the season, came home for the summer, and my leg was not what it was, and I could feel it, and I wasn't able to train as well as I could have. So long story short, as I ended up the following summer, the Celtics wanted me to come back to camp, and I knew I was about 60% of I was. I got an offer in Japan and went over to Tokyo and spent the next year in Tokyo thinking I'll just, again, try to rehab my leg and get back to 100%. That didn't happen either. Played out the season, which was great. And then I went back to the U.S. and thought I need a year off to try to get my body back. And so I had started my MBA at Berkeley and went back to finish up my MBA. And that was my finance background. So I finished that up.
And then you moved to New York at some point, correct?
Quick story again on that is I ended up finishing up the MBA. I had interviewed with a couple investment banks at the time, and I thought I had some pretty good interviews, but I didn't get an offer right out of the chute. I decided I wanted to keep playing. I wanted to give it a shot. I didn't want to lose that dream, give it one more shot. So I went down to a professional summer league in Los Angeles, got an offer from a team in England. And I thought to myself, I'm not the player I was. I'm not going to make the NBA, but I need to finish this dream off.
The dream lives on.
The dream lives on, so you have to do it. So I went over to Birmingham, England, and I was there for about a month, and it was very immediately clear to me that my leg was not better. My game was probably 60 or 70% of what I was, and I sort of knew that the dream, the basketball dream was over. So
how did you bridge from that to finance? Like, was the bridge obvious to you based on your MBA?
No, just like everybody. It's athletes are put in a position where you spend all of your time doing something, i.e. your sport, and then you're suddenly, unlike most people who retire at 55 or 65 or 75 or whatever it is, you're retiring at 25 or 30 if you're lucky, and 35 if you're really lucky. And so most advisors or most athletes I know have a real tough time transitioning out of their sport because that's really all they knew. Unfortunately or fortunately for me, sort of luck was involved in the sense that I was in England. I knew my leg was not functioning like it should. I had happened to interview with a couple investment banks the prior summer. One of them called my mother out of the blue and said, "Hey, we've got a position on the desk in New York." And so I was in Birmingham. I got that call from my mom. I called the investment bank and told them that I was interested. And they said, "That's great. Well, can you start on Monday?" And this was Saturday afternoon. So I walked into the coach and said, "Look, I'm a finance major in school. Yep. This is I'm kind of a dream job at that point, being on Wall Street. I've got to take this job." And so I basically told him that I was going to head back to the States, caught a flight back to New York on Sunday night. And my younger brother, Greg, who played basketball at Stanford, and he ended up playing with the Knicks for a couple of years. He was in New York at the time. So I landed in New York. I went over to his apartment. He's 7 feet tall, so a little bigger than I am. I borrowed a suit on Sunday night and showed up at the job, my investment banking job, on Monday morning, and that was my transition. So people always ask me about, what was your transition like from an athlete to business? And it was basically about 24 hours.
It's also curious because I can hear the drive in you wanting to keep that dream alive, but you're in a team sport. And then were you kind of a natural leader when you worked in that first team in Turkey by being American on that? Like, I'm curious how this melding of team drive leadership led you kind of to where you are today.
Yeah. So many lessons from sport that I have been able to apply in life and in business. As I look back on my sporting career, it shocks me. I didn't realize what lessons I was learning along the way. But as I look back and as I have to apply some of those lessons now as a CEO, it's very clear to me that what you see in sport is a very short microcosm of a season or a business, cycle or career, and a lot of the things that are necessary to do well come in a real quick fashion in sport. So I was a captain at University at Cal at Berkeley, and as an American in Turkey, you had to be the top scorer, and you had to be the top rebounder. You were the lead player.
But you needed a team to be that.
Yeah, absolutely. So my view is, as you know, has always been, it's all about team. It's not about me. It's about the group and how the group functions in totality, and that's the goal. I mean, any great team. I've been on teams with great talent that have not won and have been really poor and have disappointed people. And I've been on teams with more average talent that have done super well. And there's a camaraderie and a teamwork and an enjoyment in the craft, in the work that comes out in spades. And that shows up in win-loss records. It shows up in success and in business. It shows up in profit and culture and everything else.
So Dimensional manages now well over $700 billion, but who you are as a company and as an organization that we've worked with since you came to Canada 15 years ago really goes back to the very early days. Can you briefly tell a story of, David Booth and Rex Sinkfield co-founding the firm, and then that timeline from that period in the mid 80s up to the time that you joined? And when did you come in, and you talk about the evolution of the firm to today?
Well, I think the evolution of the firm starts back in the 50s. So this is Gene Fama and some of the other academics. Gene's a Nobel Prize winner. He's on our board of directors. But the academics started looking at the academic data, actually at the research data, and it was pretty clear that this idea of active management, picking stocks and timing markets and trying to add value to a portfolio, when you looked at the actual outcome, the data that was by that time computer-based and accessible to these guys
for the first time.
The reality, the aha moment was that these active managers who people assumed could outperform did not. And so they not only didn't perform, but they underperformed basically by fees. That was I think an aha moment for everybody. And in the early 70s, Rex Sinkfield, who was one of the founders of Dimensional, he started the first index fund at American National Bank.
So this was an institutional fund, not a retail fund, right? Bogle and Vanguard was the first retail fund, correct?
So Bogle and Vanguard were in 1975.
Right.
But in the early 70s, 71 was American National Bank with Rex for an institutional product.
Yep.
And then David Booth and Mac McCown, who's also on our board, they started the first index fund at Wells Fargo.
It's incredible.
Yeah. So it's
these are just ideas that were starting then.
Yeah, and ideas, and there wasn't any, again, no profit motive. There wasn't a business necessarily that was significant. People thought of indexing as, Rex used to call it un-American. That, un-American in the sense that you weren't trying. You just were replicating
You're accepting capitalism.
You're accepting capitalism, which is very American. And it wasn't something that was well received by audiences, because that was the nature of the business. There was big fees, and fees were paid for active management. And the idea that there was research out there that showed that active management didn't add value, but they were still charging fees, was not something that was well received by the investment community. So that was in the early 70s. Bogle and David Booth and Bogle were friends, and a lot of the information.
I didn't know that.
Yeah, a lot of the information that they worked on at Wells Fargo, they were able to pass on to John Bogle at Vanguard.
No kidding.
And so there's definitely a connection there.
And both individuals were trying to make the world better.
That was the motive. That was the motive of it. Yeah, and Bogle was one of those guys. He was a protector of the individual investor, and Booth and Fama and Sinkfield and these guys were, I'll call it the quote unquote pursuit of truth. They were trying to say, hey, how do we access the capital markets in the best way possible, in the most efficient way possible? And this idea that prices reflect information says that there's this thing called the market. And Rex Sinkfield used to call it the great information processing machine. And the idea was that, the market price would move around and reflect information that would come into the market. And that was a best predictor of actual value of a stock. And so one thing we used to always say is that active managers aren't stupid. They're very smart. They're very educated. They try hard. They work hard. The problem is their competition is this thing called the market. And the market's really, really good at reflecting the price that we would expect for a certain set of information and certain set of news.
That is the point, right? There's so many smart participants with lots of technology.
Right.
You have to beat the collective wisdom of that.
And again, I would say it's very tough. Anecdotally, it's very tough. But then again, data that now there's 70 years worth of data that just says there's not an ability to do that. So that was, considered to be a negative message, because if you can't beat the market, why are you in the market? And one of my mentors, Dan Wheeler, I always used to say that we all have capital. We should be able to deploy that capital in the capital markets, and we should get a return on that capital. And
expect a return.
In the most efficient return possible. And if you did that, you were going to be okay. So the bad news was you can't beat the market. The good news is you can still have a successful investment experience without beating the market. And that was really the story of indexing, is if you were able to deploy your capital in an efficient way, a diversified way, a low-cost way, a tax-efficient way, and you're able to then behaviorally stay in the market through up markets and down markets, you would be able to have this experience that we really hadn't seen before in the investment space, because nobody had ever really documented the actual numbers.
So tell me about how David and Rex then decided to start with a small cap fund. So it wasn't necessarily an indexing, and it certainly wasn't a multi-factor story, because the factors were just that was before they were discovered by, was it Ralph Bonds and then the famous Fama French early 90s paper.
It was the first factor, and in terms of,
But it wasn't academically sound factor. It was just a diversification story, right?
Yeah. So the story for David Booth was that he had gone through this with Wells Fargo. They had started the first index fund. And then he had went off to become a consultant, and he was talking to big pension plans, the biggest pension plans in the world. And in most cases, he'd look at their holdings, and they might have 40 different managers, and every manager had some combination of the same 50 stocks. And so he would go in and
large
cap. Yeah. And he'd go in and say, well, wouldn't it make sense to own small cap, because you'd be more diversified having both?
But it wasn't an expected return story.
It was not an expected return. It was a diversification story. And when we think about today, global diversification makes sense in so many ways from a compound return perspective, but he was talking to clients about diversification. So he came up with this idea of a small cap fund. And that was really the first dimensional fund, which was back in 1981, the dimensional microcap fund.
It was long before you. You were playing basketball.
I was in high school.
This wasn't even on your radar.
Not even on my radar in high school. So
they started building this in their brownstone in Brooklyn, as the story goes, but it was a small cap for institutions only. They weren't even in the retail space.
They were not in the retail space at all. So by luck and by happenstance, the first research on small cap stocks by a guy named Ralph Bonds came out right about the same time. And so David had already gone in and started talking about diversification. And then this PhD at University of Chicago had come out with a paper on small cap stock returns. And it turned out that small cap stock returns had about a 3 or 4% better return than large cap stocks. So David now had a piece of information, a piece of research that says small cap stocks outperformed.
But he didn't have the performance then, that's for sure. The first 10 years are pretty rough.
Right. So that's the punchline of the story too, was that, the data that Ralph Bonds looked at was from 1926 to 1981. And these guys started the small cap stock in 81, fund in 81. And then for the next 9 years, small cap stocks underperformed large cap stocks for a 9-year period.
But look at the conviction that David and Rex had in the evidence, which every event I've ever been to over the 15 years, that runs through every single story.
Right.
There's a conviction as opposed to just looking for the hot fun, the hot idea.
And it comes back to what I said earlier about meeting expectations. So the expectations that David set with clients was, number one, you're going to diversify. You're going to have small cap stocks in your portfolio. That's good. And number two, this data on returns, we're going to show you the return, the premium, but we're also going to show you the volatility or the range of returns over various periods of times on that extra premium. And so what we showed, and what we've always shown, is we might say small cap stocks return 3% more, but there are 5 and 10 and 15 and 20 year periods where small cap premium might not show up. And that's part of the risk. So it really comes down to positioning the portfolio so that people say, okay, I can get diversification from small cap. I can get diversification from value today. But I also recognize that there's going to be moments, there's going to be months or quarters or years or 5-year periods where it does not show up. The longer people stay in it, the higher the percentages of the times that premium outperforms. And it had just happened that David and Rex, the first 9-year period, I think it was the large cap was something on the order of 12%, and small caps were something like 2%. So they had a big deficit, but they were able to build the business from zero in 81 to, I think they were at about $5 billion in 1989, 1990, based again on this conceptual view of the capital markets, this need for diversification to small cap, and then this potential premium, always positioned as not as a guarantee, not that here's small cap stocks, you should go buy it because you're going to get more return. It was a good diversifier, and there's a premium there from the historical data, but there's also a big swing in that premium on a shorter term basis.
Yeah, and as our listeners know, Ben just did a paper on exactly this, pointing out that there's different factors and different timing of when those expected returns do show up. It was still institutional all through the 80s, and then Dan Wheeler came into the picture, who created the advisor side of the business. So how did that happen, and what convinced David and Rex to consider that? Because it wasn't in their wheelhouse before.
No, not at all. Dan was a financial advisor in the mid 80s, and he was working for one of the bigger wirehouses at the time, and felt that he was not allowed to give his full independent advice to clients. And so I think it was he used to tell a story about a client he had who was a woman that had $1 million nest egg, and this woman was just a real basket case from just she was scared, she was nervous, she had been divorced, and she had some alcohol problems, and he used to tell the story that she was somebody who was very, very nervous about the capital markets and just kind of the ups and downs and everything else. And he said that he felt that she needed to be in a fixed income portfolio, short-term fixed income portfolio, like a 1-year treasury portfolio, just to have stability until she got out of this situation. And he wasn't allowed to do that at his current employer. So he felt there's a conflict there in terms of trying to be a fiduciary and act in the best interest of the client. He wasn't allowed to do that. So he decided to go, quote unquote, independent. And right about that time in the mid 1980s, Charles Schwab, who's a big discount broker in the U.S., opened up a platform that allowed independent advisors to basically custody assets at Charles Schwab. It also opened up what they call the first mutual fund platform, and that allowed the advisor to select various funds off this platform and have it all on one statement. So an advisor could go and pick 5 different fund families, and he wouldn't have to go to the fund family directly and have those statements come from those fund family. It could all be done through Charles Schwab. So it was this consolidation of the kind of the logistics and mechanics around advice that allowed independents like Dan to be an independent advisor and have one custodial platform that the client could in essence put their assets on, and then the funds could be selected from that platform. So that was what he did in 1985. Come 1989, he was a big proponent of indexing, a big proponent of what John Bogle had done with the S&P 500. He was using the S&P 500 for his clients. And he came across, in the newspaper, the dimensional microcap fund and thought that was interesting. Again, loved to give his clients small cap exposure alongside the S&P. And so he called up Rex Singfield and David Booth and said, I'd love to access your funds.
Amazing.
Yeah, and they said, well, we're not interested. We're an institutional money manager. We only work with really big clients. We don't work with retail clients. And the reason for that was they felt retail clients, the perception was that the money coming from retail clients would be hot. That if markets were good, money would come in real fast.
Which it typically is. That's how the industry typically works.
And it still is.
Yes.
It still is. And when markets were poor, people would get nervous and scared and they would pull money out. And Dimensional's fund, the microcap fund, was very small, cap oriented. So it bought really small companies and fairly illiquid companies. And so they couldn't have this hot money come in and out of the portfolio. So Dan said, well, no, but I've got a different approach. I'm an advisor. I work with my clients on a long-term basis. I have an investment policy statement. I talk to them in good markets and bad markets. And we, i.e. me and my clients, are going to look different than the average retail client investor. It's going to look much more like an institutional account or client. And so Dan, gave that story to them a couple times. They finally agreed. And so Dan became the first financial advisor working with Dimensional, and he went about a year with that. Turned out the client flow was very, very stable, looked very much like the institutional assets. And so David and Rex thought that was a good start. And Dan came back and said there's a whole new set of advisors who are now independent that he'd like to make a business out of by going to them and having them access the Dimensional funds as well. So that was the start of the financial advisor business at Dimensional.
Incredible. So then he joined Dimensional, started the advisor services side of the business. And at what point did you come in?
So I came in about 4 years later. So I came in 1995.
Asset levels would have been?
We were $9 billion as a firm.
Really?
Yeah, and about $1 billion, a little bit of over $1 billion on the advisor side. So
how did you find them? And I know you talked about we all have an aha moment where this just makes sense. Yeah. When was your aha moment? How did this all come together?
Well, like always in life, there's times there's random luck, and there's times when you think you've at the trough or at the bottom. And I had, as I talked about, my injury was pushed me into New York. So I thought, okay, this is where I want to be. I can be a finance major. I can apply everything I learned in school. And basically about 3 years into the job, I just recognized that I wasn't really happy with what I was doing. I thought the delivery system that I had seen in New York was not the right one. I can get into that story in a moment if you like. But it was very much high commission, high transaction, high turnover. And I didn't think it was the right solution for me as an investor or for most clients when I watched how the mechanism was played out. So I was on the desk in New York, and I happened to look at the USA Today, and there was a small ad, 2 lines in the bottom of the right-hand corner of the 17th page, and it said Money Manager, Santa Monica, California. And I was a California kid.
Right.
I liked those 3 words, Santa Monica, California. So I sent a resume in, and it turned out it was Dimensional. And I got out there on a Christmas break in 1994 and went up to the office there at Santa Monica, 11th floor, and got off the elevator, and there was Dan Wheeler there to meet me, and then off to the left was David Booth, and who was the founder and chairman, and then a guy named Merton Miller, who was one of the original board members, Nobel Prize winner.
Yeah, I was going to say, no slouch, obviously.
No slouch at all. And David walked up and said, "Hey, Dan," he says, "I've got another meeting. Would you mind taking Merton to lunch with you?" And Dan said, "Well, sure, but I've got this new
young kid
potentially." And they said, "Oh, that's great, and that's fine." And so we went to lunch. My first interview at Dimensional, and I'm sitting there with Merton Miller, Nobel Prize winner, and Merton, nicest guy in the world, most modest, easy, funniest guy I've ever met. And he was talking about all these simple capital market tenets. Markets work, diversification is your buddy, he used to call it, cost matter. And we had this really amazing lunch, and then we went upstairs to Dan's office, and Dan sat me down, and he basically said a line that I remember to this day. He said, "We are going to change the way investors experience investments in America." I thought that was a pretty significant line. We're going to change the way the client experience happens. And I went back that night and pulled out my old corporate finance books and saw all the names that I had come across in that day, and this idea, I thought to myself, I could potentially be in finance, and I could be doing something that I was really proud of. And up to that point, I was, as I was going to say, in New York, I had decided I was going to get out of the industry completely, and I was going to go be a high school basketball coach and teacher, and I was just going to leave finance. So again, one of those, is it luck? Is it how things roll through life as you look back? But it was one of those moments. It was my aha moment where I sit there and listen to Dan. I thought, this is very different from what I was experiencing in New York. And what I was experiencing in New York, just real briefly, was, I had a broker, and that broker would call me on a daily basis, basically, and would pitch stock ideas to me. And the idea was to get me to invest and to transact, because each time I transacted, he got a pretty healthy commission. And when I was thinking about it, I thought that, this guy knew nothing about my financial situation. He knew nothing about my family. He knew nothing about my net worth. All he wanted me to do was to trade stocks. And I had a moment in my last year there where this guy had called me, and there's a company called Boston Chicken. And Boston Chicken was a kind of a startup chicken company or chicken restaurant in the States. He said, well, Boston Chicken was trading at 17. It was going to go to 24. And there's an earnings announcement tomorrow, next week. We think you ought to buy it. And so I took half my net worth at the time, which was about $10,000, and I put it all into Boston Chicken, because I thought, he'd mentioned the all-star analyst at this firm had had said it was a great company, and he pitched it. And I did some of my own research, and I thought, I'll invest big in this. Long story short is the following week came, the earnings announcement came. I was on a business trip in Utah. I ran downstairs. I got a Wall Street Journal at the lobby. I opened up the paper to look for Boston Chicken, and instead of saying 17 or 24, which I had hoped, it said 7. And I had that moment of hope. I thought to myself, well, there's a crease in the paper. So I thought maybe there's a 1 slid in between the crease. And so I pushed the crease out, and it wasn't there. It was a 7. I called him up and said, what happened? And he said, well, it just didn't work out the way we expected. And I thought to myself, that was his answer. And I'm sure he had to make that answer to a bunch of other people he had promoted that particular stock to. And I thought that's investment advice. The way investment advice was built out at that time was just that, was to transact
and to distribute,
to get commissions, to distribute. And this kind of always having to say you're sorry to clients was kind of the inevitable outcome. And that was no way to really to do business or do finance or to do investment advice. And so that was an aha moment. And fortunately, right about that time, I had picked up the paper, and literally a month later, I'd gone out to Dimensional. I heard this completely different story about the client experience and about being a fiduciary and acting in the best interest in the client. I thought, I could do this. I could do this for 5 or 10 years, I thought to myself. And here we are 25 years later.
Can you talk about some of the basic principles that David and Rex instituted early on, like what being selective on who they let in terms of advisors, what sort of principles they'll apply in portfolios? Because you don't see Dimensional have any sort of high-tech fund or any sort of flavor of the month type fund. Like you're very deliberate in how you release products, but there's been things that I see that have been very deliberate rules right from the get-go that don't seem to change, but I think made a huge difference.
Yeah, I think so. On the quote unquote distribution side, goes back to the story I told earlier, was that David and Rex knew that there was institutional clients in the commingled funds, so the mutual fund portfolios. And they needed to confirm that any assets that were going to come in from the retail side, i.e. the advisors, was going to be compatible to the institutional assets in terms of being long-term buy and hold. So part of our process at the front end, and Dan's promise to David and Rex was, look, we won't just wave in any money that comes our way. We will have these I'll call it conversations, and we'll have these conferences and educational interactions where we have a good chance to get a feel for what the advisor does with their clients. And the advisor, as independent advisors, will have a good chance to kick the tires on us and have a longer moment of decision around whether they want to work with Dimensional and have Dimensional in their portfolios or not. And by doing that, by extending the, I'll call it the sales process, it allows both sides to make a decision as to whether you want to have a long-term relationship and whether it makes some sense to have that as part of the client portfolio. So one of the things we've always said from day one, Dan used to say, is if there's something that makes more sense for your client, you should go use it.
He told us that in 2002, definitively. If you find a better solution, you must use it because you are here representing your client.
Right. You are an independent advisor, you're a fiduciary client, you're acting in their best interests. We are one of 8,000 funds on that Charles Schwab mutual fund platform. Our job is to basically get the advisor to understand why our portfolio is better for their client than the next one on the sheet. And if that happens, then they're going to use us. And if it doesn't, then they're going to use something else. So that's the one thing we've always been really clear at, and it's been really important, is we've got this nature of independent advice is so different than what we would call vertical advice, where there's a big company and there's an employee who's actually a salesperson for that company, and they're pushing product down to the
and they have budgets and sales targets. Like I know you do not have sales targets. I don't think David even believes, and I don't think you believe in targets. It will be what it will be. Just keep doing the right thing. And
right, we're the one beauty of we're a private company, and David Booth's run it, and it goes back to the pursuit of truth comment. These guys, all these Nobel Prize winners, they really are academics at heart. They want to find the right answer. We talk about, what would we do with our own money? How would we invest it? Yeah. And so it goes back to your point about, did we jump at a tech fund because tech was hot? No, because it didn't make conceptual or academic sense to have a tech fund. It was a sector fund. It didn't make any sense.
You could have gathered assets.
We could have gathered assets, but these guys have consistently been very robust and I would say sensible about how they view the capital markets and the research. And there's a really high litmus test. The thing I'm really proud of Dimensional is that when we do our work and our research and think about portfolio construction, portfolio design, and implementation, we have hundreds of people working on every detail of that portfolio, from research to portfolio design to portfolio management to trading. And in each sense, we're trying to squeeze out that extra basis point, because the idea is that those basis points over 5 and 10 and 15 and 20 years, it might not seem like much. Who cares, right? 10 basis points or 5 basis points. But 5 basis points over 20 years on $1 million portfolio becomes a significant amount of money. And so, we're acutely aware of that, and we build our business around the idea, again, of trying to get to the most efficient answer for the client. And that's been, I would say, one of the most things that I'm most proud of in terms of being affiliated with the company is just that.
And the client being our clients. Like, I think I tell our clients that you don't work for us. I view you as working for our end client.
Absolutely.
Like, we are beside you working for the client.
It goes back to the early days in Dan's view on the great investor experience, investor being your client. That investor experience happens when there's great expertise at the capital market level, which is what Dimensional does. We provide the expertise at capital market level. And then at the client level, the advisor is providing the expertise. We know nothing about the client. We know nothing about how you would allocate for your client. We know nothing about their risk profile. We know nothing about their family. We know nothing about their charitable aspirations. What we do know is we know how to build very, very efficient portfolios that are, in essence, building blocks that you as an independent advisor can take and build out the right solution for the client. And again, we think that combination of those two pieces delivers the great client experience. That was what, the essence of our purpose and our mission was from day one, is how do we give a better client experience than what we see out there? And Dan didn't see it where he was. I didn't see it where I was. Brad Steinman, who runs the Canadian business, he was a guest on our podcast
a couple months ago.
Same thing. So the nice thing is we've had this community has been built of a lot of people who have been in the business for a long time. They've seen the negatives of the financial services business, and they wanted to change it. And that, again, when you have that kind of purpose and that energy, then it turns into a real mission. And that's what's made Dimensional successful over the last 20, 25 years in the advisor space.
How do you react when, because I know we hear it, I'm sure you've heard it, DFA is kind of cult-like. They don't give us access to their funds. And I know we have a lot of do-it-yourself listeners to this podcast. What do you think when that comes up?
Yeah, there's you hear that occasionally. I think it's one of those where we're committed to this model. We think the advisor role is supremely important in delivering the investor experience. So, our view is that we can put out great portfolios, and if they aren't used properly, it can be a very, very bad investor experience or outcome. So, we have a fund that's called the Japanese Small Cap Fund. And the Japanese Small Cap Fund has been the highest ranked mutual fund in the world at periods of time. And it's been probably the lowest ranked mutual fund in the world. And if we were to allow the fund to just be out there, many would say, it's the best performing fund in the world. I'll put my money in that. And then if it wasn't the best performing the following year, I'm going to take my money back out. And so it goes back to my point around there's an obligation that we have from an investment, from a shareholder perspective. We need to protect shareholders in the funds. We can't have hot money coming in and out. That's detrimental to the funds. So on the institutional side, we have a process in terms of how we work with very big clients and governments and so forth. On the advisor side, we have a process which is a methodical process, and people have complained about how long it takes for us to go through our methodical process.
It's not easy to get access to be an advisor with you.
It's not easy, but it's about advocacy. We don't want to have, and I think of outside the financial space, just, you think about sales. There are people that pressure people into buying something. And oftentimes the next day people wake up and go, oh God, why did I buy that? We're not in that business. What we try to do is we say, listen, here's our story. We're going to lay it on the table for you. We want you to go off and we want you to navigate through that story. And if there's a moment where it resonates and a moment where you say, that would be good for my clients and that would be good for my business, et cetera, then we want to come back and we want to have a conversation. And so that's the process. That's the process that's worked for many years. We have very consistent cash flow, as you know.
Which is a big deal for end clients.
Right.
Easy to rebalance.
We have very consistent relationships with advisors. And I think that's built on the fact that we lay our story on the table. We set expectations. We tell you, Cameron, how we are going to build the portfolios, what you should expect. We've never promised small cap outperformance. We've said, here's a small cap premium based on the data. And there's, again, volatility around that small cap premium that you should expect. And then you should be able to articulate that to your client, and they should be ready for that potential outcome. And that's all we've ever done. So our view is if you do things methodically and slow, get people very comfortable with what you do, and then you allow the process to happen in a consistent way, people are not going to be surprised with an outcome. They're going to see that expectation that was set met on a regular basis. And I think that goes into the whole concept of trust. I mean, we talk about trust quite often. Bob Merton is another Nobel Prize winner, talks about trust. And what trust is competence plus trustworthiness. And competence being, if you look at Dimensional's, board and Nobel Prize winners and portfolio managers and infrastructure, there's competence there, a lot of experience, a lot of work that's gone into the result of the fund. The other part is trustworthiness, which is sort of a habitual meeting of expectation that if I interact with you and each time you walk away from my interaction, that you walk away and say, that met my expectations, or that actually exceeded my expectations, that was great. If that happens over and over and over again, trust develops. And so the way I describe it is kind of like your kid. You have your kid when they wants to go drive, they go get their license and they go through the process. They pick up competence from their driving school. And then at some point in line, you got to hand the keys to your kid, and they go off. They go off and drive. And if over time, if they keep coming back with turning the right way and turning on the light, you're going to have developed more trust over time because of that trust, that trustworthiness that's kind of repeated over time. So anyway, that's kind of where we are. We're really about trying to develop trust with the advisor and the advisor's trust with the client.
I'd love your thoughts on the one decision portfolios that you brought to Canada 10 years or so ago. We used to use individual funds and do our asset allocation rebalancing ourselves, but it became obvious that we can't rebalance like you guys can, quite frankly, right? And when you have positive cash flows coming in, you're able to rebalance with new cash flow, which is very tax efficient. So it makes so much sense, but it's different to a client because a client then sees one line item on their statement. We've had no problems with that. I truly believe to my core, this is the best way to do things. So we've had great success using the one decision portfolios for clients. Can you talk about what you see clients' perception of the value proposition shifting as you look at the overall financial advisor landscape around the world?
Yeah, I think there's more and more focus on holistic, wealth management, and people are, as I talk to advisors, there's certainly an investment aspect to the business, and you still have to allocate, you still have to understand risk profiles, you still have to do all the things that think about taxes and so forth, so on. And where you've commented on the kind of the one portfolio idea, there's an efficiency there in that. And the simplistic, view is if you have two boxes and you've got to, take something out of one box and put in the other one, there's going to be some cost there to take one and move to the other. If you have one box and all those same components are in there and you can slide them back and forth without tax costs, without transaction costs, that's going to be more efficient. And so the idea, and this is, 15 years ago, was these core portfolios were able to do just that. We were able to be more efficient in delivery of the capital market solution there to clients. So that's been important. I think the wealth management aspect, I think is just getting more, there's more depth in the relationships with clients. I think the advisors are knowing more about the client situation and what their hopes and dreams are, what their retirement will look like. And so I think there's a bigger emphasis now on that. How do you develop some areas of expertise that's going to be helpful to the overall client situation? So, I have an advisor, and my advisor and I spend a lot of time on those types of concepts. And what do I want to do in my charitable giving? How do I want to think about my kids' 529s or that's the college education funds? And there's a lot of those kinds of conversations that happen in addition to the old investment conversation, which is what we've always historically have had. But that's kind of where I think the role is moving. And the last part of that, again, is I'll come back to this comment about trust. My advisor, my wife doesn't have any interest in finances at all. And my kids I got 4 kids under 16. And part of the reason why I have an advisor is that I know there's one phone number that if something, God forbid, ever happened to me, I'd be able to hand that number to my wife, and she knows my advisor well, and he would take care of the family. And so just that in itself, people would say, well, that's different from investment advice as it historically has been known. But that's a big component of what I would consider to be the relationship. And so the relationship on the advice side, I think, has expanded to a very high degree from where it was maybe when I started 25 years ago.
So you're co-CEO with Gerard O'Reilly. You guys clearly get along very well. You've worked together for, I think, 15 years or so. And he's a great individual also. You talk about how you manage this together and where you see the firm going from here.
Yeah, I think the relationship has been great, and we've known each other for 15 years. We didn't really work as closely, obviously, as we do now. He was a research person, a PhD from Caltech, rocket scientist, and I'm a guy
Literally.
Literally. So super, super smart guy. But what I think, people always ask me, how does co-CEO work, and are you able to be effective as a co? And I think it comes down to the people. I could imagine if two firms got merged together and two CEOs came together and they now became co-CEO, that would be a problem in terms of kind of the alpha orientation about who's the dominant one and who gets control and that sort of thing. But the one thing I will say and I appreciate about Gerard, and I think where our relationship has really thrived, is he's a super smart guy, but he doesn't claim to have every answer immediately. So he uses a term, and this is I think a research term. He uses the term prior. My prior is this, which basically says, I believe something, here's what I see, and here's what I think, but I'm willing to listen to what you have to say. And as you know, as a married guy, and it's like with your spouse, it's just you have to have that openness to conversation, to collaboration, and so forth. Otherwise, you're going to get stuck in your holes, and you're going to pound heads with one another. So I look at that as really kind of the essence of the relationship is like a mutual respect. He knows I've got a lot of experience with advisors over the years. I know he's got a lot of experience on the research side. And we spent a lot of time thinking about how do we make that the best collaborative kind of environment possible. And it takes communication. From day one, I walked in and I told him, I said, look, we can either do this together or we can do this separately. And if we do it together, it's going to be really fun. If we do it separately, it's not. And so I think we have to share everything. We have to be completely transparent, completely candid. We can't have any secrets or politics or anything like that. And he was in complete agreement. It's worked out just like that. So we laid some good ground rules early. It's progressed in the way that I think we both had hoped.
Well, this goes back to the models that the economists use, like Fama and French. Like they just build models of explanation to reality, but it's not necessarily reality. So you guys are always open to change. And that goes right back to your roots of working with Fama and French and all the different academics that are here. So what is it like working with those kinds of people? And you work with them regularly on board meetings and whatnot.
Yeah, it's incredible. They are, the most inquisitive. They're obviously all smart, but they're very modest and they're very, they're funny. But I think that, the modesty part is the part that strikes me the most, I think, about working with this group. And I think it started with Merton Miller, because people always talk about Merton as being the kind of the godfather of all these economists. But the way Merton collaborated and the way he had this level of modesty that was unparalleled, I think he set a tone for these guys that there always is another answer around the corner, and you've never finishing what you think you have. You never have the complete answer, and a model is just that, right? Model is not reality. Yeah. And if it was reality, it wouldn't be a model. That's what, Fama and French and these guys will always say. So what you always try to do is you try to look at the empirical data that's out there. You try to build models that explain that empirical data to the best way possible. And you continue to tweak that model to do better and to do more. And so the term that I heard Fama use one time is it's called the pursuit of truth. You're never going to get to truth, but you're always in pursuit. And I would say at Dimensional, that's really the culture of the business, is this constant pursuit. It's a constant pursuit in trading. How do we trade a little bit better? Can we do this? Can we tweak that to get another basis points? In research, can we use this information to, translate into portfolio advancements? But all of it's done with a very wary eye. And I think that's where if I was a client of yours or of any advisor we work with, one of the things that I would take satisfaction in is that you don't have this firm that's leveraging models and shooting for the moon and hoping for the best. It's a very sensible, methodical approach to capital markets and what we deliver. And again, going back to the 38 years of the firm, the delivery has been just that, very consistent, very methodical, very clearly thought out advancements in the capital market space. And Dimensional, frankly, is number one. I mean, Dimensional is the firm that you asked the question earlier on, when we talk about multi-factor and smart beta and all this stuff that's starting to bubble up in the market. Dimensional's been doing that for 38 years. They were the first ones in there.
First ones.
And by a long shot. So, it's interesting to watch the market. The market's transitioned from where I started, which was high transaction, high cost, pick stocks, time markets, hope for the best. Look in the crystal ball and find something that's going to be an answer that's going to make me better off, to this new model, which is, built around, low cost, diversification, multi-factor investing, coupled with independent advice, which puts the client in a much, much better situation. So that was what I think Dimensional modeled, 30 years ago on the investment side and 25 years ago on the advice side. And what we see now is we see this massive shift, I think, in the industry overall moving in that direction, which, if you say, what's your greatest satisfaction, it would be just that. I think the clients are much better off today than they were 25 years ago when I started. I was paying 5% transaction cost on each stock trade. And when you think about what advisors charge and transaction costs, it's come way down.
Come a long way.
And then there's an independent factor, which makes it a completely different experience for the client. It's a much more fiduciary-oriented interaction. So things are positive. I don't see it's slowing down. I think, the energy is the right direction. And, again, that's why we all got together, Brad and Dan and myself. We didn't have any hopes of some size of a firm. We just said, if we want to change this, we want to make it a little bit better. And I think, along with all the advisors we work with, I think we've done that to some degree.
So my last question, I know we're tight on time. How do you define success?
That is the $1 million question, right? For me, I think, it's family. I think if I can, my wife and my kids are happy, success does nothing to do with accomplishment or dollars or anything like that. If they're happy and they're well balanced and they feel good about who I am and what I've done with them and for them, then to me that's success. And I would say the same thing with people say, well, as CEO, or did you do this, or did you get this award in basketball? I was like, none of that ever really mattered to me. It was really more about the process and the pursuit of doing something well. And so the purpose part is the part that I feel if you can hit whatever your purpose is, and there's all kinds of purposes out there in life. If you can do that and you can do it in a consistent way and have people say, that person made a good impact on that, that's total success.
Well, you certainly found a great place to do that here at Dimensional. And over 15 years, you had a huge impact, you and the whole team, a huge impact on us as advisors, but also on the lives of our clients. So we appreciate that. And Dave, thanks for the time.
Thanks, Cameron. Appreciate it.